people connecting throughout. We have quite a few people registered for this webinar. Welcome. Thank you for registering. Thank you for getting up to this point. We are the Hispanic Business Center. Yes, we have a big H, HBC. We have a big H, which is for Hispanic, but by no ways do we only work with Hispanics. We work with everyone. It's just we have the capacity to work with individuals who need Spanish, either because you're monolingual or Spanish preferred. And so don't let that discourage you or make you think otherwise. We are free and open to work with everyone. We are located on the heart of La Villa Hispana, the Hispanic village, on literally the corner of West 25th and Clark. This is my neighborhood. I'm born and raised in this neighborhood. And so we're an SBDC Small Business Development Center, and we work with clients on all facets of their business, whether it's a pre-venture, startup, or pre-existing business. To give you the very short breakdown, the easiest way I can break it down is we have two accounting advisors, we have a marketing advisor, and then me and Victor, who is the newest team member in our office, who work with all clients regardless of where they're at in the spectrum. All the services are free, and so please take advantage of them. If you have any questions or concerns, you can reach us via phone or you can email us. You guys in your registration, you have received all that information. So you've probably already received about 2 emails up to this point from us. Feel free to reach out to us. We will do our best to get back to you immediately. Other than that, I think probably most of you guys know what the SBDC is. If it's not, that's a great way to follow up with us. You can follow up with me, and we will make sure that you have all that information. Nonetheless, I don't want to take too much time because I know that we have quite a few people that are going to be on this webinar, and some of you may have questions, and I want to give ample time for Ray to be able to go through his presentation and also answer questions that are pertinent. So thank you all for attending. Please don't hesitate to follow up with us or send us an email or communicate with us. We are here to serve you for free, and we will help you. If we don't have the capacity in-house, I promise you that we have a connection for whatever that may be, and we will do the best to help you reach your goal. All right, so without further ado, I want to pass it over to the lead lender relations specialist, which is Ray Graves from our local small business administration district office. Ray?
Randy, thank you so much for the gracious introduction. I appreciate that very much. And thanks for the partnership. We appreciate everything you guys do. And without the real small business help that you guys do on the ground there at 25th and Clark, we would be lost without you. So thank you so much. I am going to be going through funding options from the SBA in the next hour or so, funding your business with SBA funds. Also talk a little bit about business planning and sort of what it's like to approach a lender for a loan with sort of a focus on this pandemic environment. If you've got questions, I don't mind at all having interruptions or anyone wants to break in and do a question, or Randy, if you're going to stay in line, you can do the same. But I'm going to try and get through the next 20 slides or so that we have enough time for some questions at the end as well. And with that, let's go ahead and set the agenda. You should be able to see on your screen the agenda that I've got that I want to talk about today. A little bit about the SBA background, a slide on that. We're going to talk about the SBA loan programs, both the ones that have been put in place to deal with the current crisis, as well as the historical programs that remain in place and remain strongly active in this environment. We're going to talk a little bit about business planning, and then spend a lot of time in the lending process, answering questions such as how do I get a loan, what documents are required, how much money can I get, which is one we get a lot of, and how much time will it take. But first, a little bit of the background. And what we say at the SBA is that we are the agency of the federal government that makes the dream of business ownership a reality. We empower entrepreneurs and small business owners with the resources and support they need to start and grow their businesses. And we're the go-to resource and voice for small business, backed by the strength and reach of the federal government. No matter what stage you are in your business journey, SBA has a solution for you. We help start, grow, expand, and recover businesses. In the last 5 months or so, we've been really focusing on that recover part, but we remain active in the business formation, the growth stage, and the expansion stage of business. So turning to the programs that SBA put in place to deal with the current pandemic crisis. The first thing is the SBA Debt Relief Program. That's very simple. SBA Debt Relief just means that on any SBA loan, many of our historical programs, whether that's the microloan program, the 7A program, or the 504 program, and we'll be talking about those in greater detail on successive slides. But on any of those historical or legacy programs, SBA will make 6 months of payments for existing SBA borrowers or new ones going forward if your loan is closed before September 27th of this year. So that's a pretty good deal. Secondly, the Economic Injury Disaster Loan was probably the first loan program that we had available off the shelf in March when the disaster response was being crafted. Economic Injury Disaster Loans, or EIDL loans, are direct loans from the federal government. You access these loans through the SBA.gov portal. They could be used for working capital. Working capital means short-term cash needs. And it's designed to be sort of X months of working capital. And it could be, I'm not exactly sure what the formula is that the Office of Disaster Assistance is using, but it's generally going to be, 6 to 12 months of working capital for your business. And the way they calculate that is a very, very simple formula. Again, I don't have the exact formula, but it's going to be some function of the gross profit of the company. So in some cases, we've had people say, hey, how come I didn't get an EIDL? And it turns out they had no gross profit last year. And so that sort of screws up the function. If your company doesn't have any gross profit, then it's probably not going to get an EIDL. These are working capital loans that have a 30-year repayment, which is an extremely long amount of time to repay what should be a short-term working capital loan. So it should be a very affordable payment. But these are loans. The rate is a normal rate. It's about 3.75% of interest. No collateral is taken up to $25,000, and typically no personal guarantees are going to be taken. Usually these loans are $150,000 or under. And the maximum loan size, again, $2 million, but from what we have heard, by far the vast majority of these are $150,000 or less. So that's pretty much the maximum that I think people should expect to get. Now, up until about a month ago, we also had something called the EIDL Advance Grant Payment. Those funds have since been depleted completely. There are no more EIDL Advance grants going out. Everything now is through the typical loan program, which is, again, 3 3/4 rate of interest, a 30-year repayment, and typically a maximum of $150,000 or some portion of a year's worth of gross profit. Finally, and probably the most important of these is the Paycheck Protection Program. Paycheck protections are forgivable loans. They're made by a local lender. They're intended to bring employees back on payroll or to maintain payroll. These are loans made by local lenders, guaranteed by the government. Eligible uses include payroll, rent, interest, and utilities. The loans are guaranteed 100% by the government to the bank, so the bank has very little risk. There's also no recourse against the owner of the business, so there's very little risk for the owner. But it's a great way for us to harness the private sector to make sure that people stay employed and make sure people stay off the unemployment rolls. And if the business is able to resume operations and make any money during that period when effectively the government is paying the salaries of the employees, that's great too. But it's not necessarily required that the business be operational in order to get a PPP loan. All that's required is that payroll be paid to the employees. Now, the big benefit of a PPP loan is that, in theory, 100% of it could be forgiven. And by forgiven, I mean the federal government paying off that bank and the bank then forgiving the note to the borrower. But if for whatever reason there are amounts of the PPP loan that are not forgiven, well, then the remaining amount is actually amortized over the next 5 years, and the rate is 1% interest. So, on this slide, I've got 18 months, but that was changed by the CARES Act, I think the Flexibility Act. So now that if there is a small amount that's not forgiven of these PPP loans, the rate of interest is nominal, and the time you get to repay it of 5 years is extremely long. So it should be a minuscule payment if there is even one at all, which we're hoping there will. I guess now's a good time maybe to pause and see if anyone has any questions directly to these programs before I keep going. So I'll just pause for a second in case there's anything. All right. In that case, I'm going to advance my slide, and I'm going to talk about the SBA's sort of legacy programs, the historical programs that are still in operation. And these are 7A loan guarantees, the 504 Certified Development Company Loan Program, and the SBA Microloan. Now, an SBA 7A loan guarantee just means a loan from a bank where the SBA is guaranteeing a percentage of it. Fees on these loans are typically around 3% of the guaranteed portion. Interest rates are typically prime plus 3 to 5%, often prime plus 2. Typically, the terms are between 5 years and 25 years, always fully amortizing, meaning the term of the loan is the same as the amortization of the loan. You don't have to worry about the loan maturing with the balance remaining. And there's no prepayment penalty on these loans under 15 years. But a 7A guarantee is just a very general purpose loan. It's a bank loan, and it's a bank loan where, for whatever reason, the bank decided there was a little too much risk. And so they applied for what's effectively an insurance policy. The next of these programs is 504. And this is where someone is purchasing a property or buying a heavy piece of equipment, some substantial project, and they're looking for the best payment terms possible. What happens here is the SBA actually sells a bond, sells a bond on the market as the federal government. We actually go out there and do this ourselves. And when we borrow on behalf of a small business, we got a pretty good interest rate. So we sort of transfer that savings onto a small business that couldn't sell a bond on the market themselves. So these are long-term, low down payment, fixed interest rate loans for major capital intensive projects. On the whole other end of the spectrum is the SBA Microloan, which is an alternative lending source for non-bankable clients, focusing on very small amounts of working capital for startups, business owners that have credit challenges, minority and women-owned businesses, anyone who cannot access the typical conventional bank market for one reason or another, or they just don't feel comfortable. Our microloan provider here in Northern Ohio is ECDI, the Economic Community Development Institute, and they have an office up on Euclid that you can apply for a microloan for. Now, all three of these programs, as I referenced before, have been buffed up or supersized by the SBA's debt relief program, meaning anybody who already has one of these kinds of loans or who is getting one of these loans in the near future will have 6 months of payments made by Uncle Sam, which is a pretty good. These programs are all necessary because small business loans are sometimes considered exceptionally risky by the traditional banks. They're considered risky because small businesses lack reserves, they lack track record. Usually there might be one or only two key managers. They're exposed to competition and competitive effects. They're exposed to economic cycles. They may have supplier or customer concentrations where if they lose one supplier or if they lose one customer or one major client, the business could be very adversely affected. So they tend to be very erratic and very variable. And banks, especially larger banks, don't like that. They really want a sure thing. So SBA steps in and we guarantee the bank's loan, meaning their downside risk of failure on one of these loans is mitigated by the fact that the government is putting in an insurance policy on these loans. So this is a really good deal for small businesses because it means they're able to access capital that they could otherwise not be able to get. So if your small business is successful, if you're doing very, very well, and you can apply to a bank and you can get a loan without an SBA guarantee, then we urge you to do that. There's no reason to get an SBA guaranteed loan unless you need one. But it is a very big program. We do tens of thousands of these loans every year, about a couple thousand in Northern Ohio every year. And if it's something that can help you, then we certainly want you to take advantage of that SBA loan. And as I said, with the debt relief program, it's a really good deal right now. So you may want to try requesting one of these. But again, I think it's best to keep in mind that these are loans that are for folks who cannot qualify for conventional financing for one thing or another. So if you do qualify for conventional financing, we urge you to go that route and to go that conventional route. But the funding is here from SBA if you need it. Okay, let's talk a little bit about eligibility for these loans. SBA loans, the whole spectrum of them, are available to for-profit businesses that are small, engaged in doing business in the United States, have reasonable invested equity, use alternative financial resources to the extent they're available, have a need for the loan proceeds, have a sound business purpose, and not be delinquent on any existing debt obligations to the government. We're not making these loans eligible to lenders, developers, and landlords, foreign-owned entities, pyramid schemes, businesses driving more than 1/3 of gross revenues from gambling, private clubs, teaching or instructing religious practices, anything that would be indecent or considered indecent, political or lobbying activities or speculative businesses cannot get one of the traditional SBA loans. This eligibility framework was relaxed a little bit for the COVID response. And in some cases, not-for-profits, even churches even, have been eligible for the COVID response funding, but still not available for your 7A 504 and microloan. SBA loan activity in the last several years has been pretty robust. For example, these data sets here show about 1,500 loans per year from the 7A and 504 loan program in Northern Ohio. And your typical loan size is about $250,000, but more active, more frequently loans are between $25,000 and $100,000. There are a few outlier large deals. It might be $4 or $5 million, but the vast majority of deals are between $25,000 and $100,000. So, for example, in fiscal year 2019, the lead lender that we had was Huntington Bank that did almost 900 SBA loans. But we're fortunate in Northern Ohio to have a long list of lenders that are each making more than 10 or 15 loans a year and are pretty familiar with the SBA product. So those include Growth Capital Corporation, Key Bank, Consumers National, Citizens Bank, and so on and so forth. So you've got lots of options for getting SBA loans. Pretty much every major lender will do an SBA loan, so you can ask them about it, and they'll have a good familiarity with it. Okay, I'm going to pivot now a little bit to just talking about business planning, because when you are in the market of going out and getting funding for your business, it makes sense. It's not a requirement, but it certainly makes sense to have a great business plan. Business planning means different things to different people. Hispanic Business Center may have a different idea of a business plan than the CSU Small Business Development Center or the SCORE mentorship program. But no matter what you're doing, if you're writing up a business plan, you're thinking of getting funding, I would have a written business plan. I would spend time validating the concept, evaluating my competitors, understanding entry costs for the business to see if it's easy or difficult to enter the business and what kind of capital you're going to need to enter the business. Preparing financial projections is key. Understanding financial statements. A successful business and a successful loan application starts with an educated, well-prepared entrepreneur. So think about some of these concepts when you start putting pen to paper to get a loan, because you need to understand these things for your own purposes, if not for the lender. Most lenders don't really want a full business plan. They want a great loan application. They are a little different. A business plan is like a strategic internal document, but an application for a loan with a good executive summary focuses on how you're going to pay the loan back. It focuses on, this is the cash that I want, and this is how I'm going to pay the loan back, rather than sort of the 30-year plan or 20-year plan. If you need help on the business plan side of things, certainly turn to the Hispanic Business Center, to Randy. Also take advantage of resources that are available at the other small business development centers or at our mentorship program, or at ECDI, which has the Women's Business Center associated with it. All of these opportunities are available. All these sources are opportunity available for you for low-cost help on your business planning or your needs. I've got a slide here that shows the addresses and phone numbers and directors of each of the small business development centers. You can certainly Google that as well. Just Google Small Business Development Center, Cuyahoga County, and get a good list. But I'll make a special point of reference to SCORE here. SCORE is our mentorship program. It's a volunteer organization. The volunteers are former business owners or business professionals. They just have retired frequently, or sometimes they're not retired yet, but they just volunteer their time to help people start and grow businesses. So it's a great source of education and help as well. Okay, so how do I get a loan? That was one of the questions we started off with here. Getting a loan involves a multi-step process. It's not something that happens overnight. A lot of people think, it's pretty easy to do, and it's not incredibly difficult. It happens all the time. People get loans all the time, but you do have to have a little bit of preparation. And I would recommend, number one, spending some time building your expertise. Attending different seminars, learning about financial statements, etc., so that you know what you're talking about when you talk to a lender. Number two, not being a startup helps a great deal with getting a loan. When we look at our numbers, it seems to be the case that about a fifth of our loans go to startups, and that's not an inconsiderable number. It's a couple hundred deals a year, but it's much, much easier, clearly, to get a loan when you have been in business a couple years. And that's again because lenders want to see some ability to repay. And the easiest way to determine ability to repay is to look at what a company did last year. So understanding how much you can afford is number three. And that sort of comes down to what cash flow do you have or will you have available, and how much equity do you bring to the table. So I guess we could talk about that a little bit more, but typically what cash flow you have means the amount of cash that you have left over after paying all of your expenses every month is sort of your available cash flow. And if you think about how much money that is in a typical month, some portion of that is what you could qualify for in a loan. A loan is just fundamentally getting a big slug of money up front, and then paying it over in small increments over time. So think about how much money your business is generating and how much money is available to pay a loan. How much equity do you bring to the table? Usually lenders are going to want to see a certain amount of your own cash into the project. And that could be 10 or 20% of the project. But if you go to a lender and you ask for $100,000 to buy a $100,000 piece of equipment, that sort of makes sense, but the lender is going to want you to put in some of the cash. So it's a lot easier to apply for a loan successfully if you're putting in, say, $10,000 and you're asking for a loan for $90,000, or better yet, putting in $20,000 and asking a loan for $80,000, rather than asking the lender to foot the entire bill. Reviewing and optimizing your personal credit is a very, very important thing. In most cases, small business owners should be thinking about, maximizing and optimizing their personal credit before applying for a business loan, which again is a little counterintuitive because many of you know that businesses do have, business credit of their own. But in most cases, lenders are looking through that. They're really looking at the personal credit of the owner because it's the fact that individuals who pay their bills typically have businesses to pay their bills. So creating a great loan package is another thing that you need to do. Make sure you have financials that make sense. And selecting a lender to apply with is the last thing. Here's just a quick look at the application that a lender is going to give you when you approach them for a loan. So this happens to be some documentation from ECDI, our microlender, but they're going to give you a term sheet that's going to show you what kind of terms you can expect. And then they're going to give you an application, and there's going to be a lending process. So in the case of this particular lender, they have an 8-step process. Each part of the process takes a few days. First you contact ECDI, then you apply, there's an application fee, there's a background review, they're doing a credit check, that takes a couple of days. Then there's an underwriting process, meaning within the lender, they're looking at your ability to repay, your debt service coverage, any outside income you have. They're reviewing your documents, whether it's a purchase agreement or cost estimates. Step 5 is when they're issuing an approval. Step 6 is issuing a letter of intent to provide funding. And there's a compliance review and then a loan closing. So it kind of gives you a sense that each of these steps takes a few days. It's not an automatic process. Many lenders are going to have a faster turnaround time than ECDI, the microlender will. But ECDI is a good place to go if you're not able to access bank financing at all. So creating a great loan package means having a lot of really good information for the lender up front. It's a little different, as I said, than a business plan. Um, so here's a good list of just sort of like what sorts of things you should expect to have in a loan package. If you came to me and I was a lender and you had all of these things in a package in a binder, I'd be very impressed with your preparations. If you've got an existing business, you know, you might just be able to go to a lender and get their official application and provide some financial statements to be done. But if you walked in the door and you already had these things filled out, I think that's a great way to impress the lender that you really know what you're doing. So include a business overview and history, a brief summary of the business and what it's doing. You know, talk about the challenges or talk about successes that you've had, a narrative about the last few years, what you're trying to accomplish now with the funding. Cost documentation, a clear sources and uses statement, by which I mean, what are you using the money for? How much money are you requesting? How much money of your own are you putting in? The SBA has a loan application, Form 1919, which you could fill out, which would be great. A personal financial statement from the bank or from the SBA could be filled out. That's the SBA Form 413 if you want to use our form. Make sure copies of your business financial statements are available. And you should have a financial statement for the most recent several year ends, but also for something current within the last 90 days or so. Include your income tax returns. So that'll be on the personal income tax returns and your business's income tax returns if it's different. Many sole proprietorships, of course, are going to include their business on their personal tax return, but if you've got a corporation, you might have a separate tax return. You're going to need both. Have some projected financial statements that include the debt that you're requesting, so that we can see how the ability to repay works out. Have a statement of your ownership and affiliations in other businesses, a copy of your business certificate or license, your resume to prove your personal ability to run a business is excellent. If you've got a lease, you might want to include that. If you're a startup, you're going to need to include that full business plan. But if you are in business already, just having these documents is a great way to go. If you are just a startup and you just have projections, then that full business plan might be less. If you're having trouble finding a lender, the first thing to do, of course, is to figure out where do I have my existing accounts, talk to the financial center manager or branch manager, ask to speak with a business banking specialist, and go from there. But if you don't have one of those sources, you can certainly use the SBA's lender match system, which just links you up with lenders that are out there that are interested in making SBA loans. So you enter minimal information, it gets sent around to essentially a lending tree sort of service, and then you'll get calls from lenders that want to make loans. Question we get asked a lot is, will I be approved? And that's, of course, a really difficult question to answer without having a lot of the information on the business. But you can kind of figure out where you stand by looking at these factors. The most important factor for whether you're going to get approved by a lender or not is historical cash flow coverage. Historical cash flow coverage, again, is just sort of the net cash you have left over after every month. And it's divided by the debt service that the loan will have. By debt service, I mean the monthly payment amount. So if every month you generate $300 extra of cash, which goes into savings, and you apply for a loan from a lender, and the debt payment on that loan is less than that cash flow, you've got a good chance of getting a loan. Usually, lenders want cash flow that's 120% of the debt service that you're requesting. That 1.2 coverage ratio is sort of the most important thing when you're figuring out whether or not someone's going to get a loan. If you don't have historical cash flow at all because you're a startup or you're doing a big expansion, then you've got to show projected cash flow coverage. That's a lot harder to do. Personal credit, as I said before, is critically important. 700 credit score is the median, or was the median before the pandemic started. That might have changed quite a bit by now. But try to, as best you can, coach up your credit score to that 700 level. We find that folks that have a 700 credit score have a whole different world of opportunity as far as access to capital than folks that have below that 700 score. So one of the best things that we can do to get access to capital to everyone is to really coach people on bringing that credit score up, because once you get above a certain level, lenders want to make a loan to you rather than you trying to find a lender that's willing to make a loan to you. There's an inflection point. So coach up that person's credit. Lack of collateral is important to get an approval, or collateral is important for an approval, but lack of collateral isn't the only thing that's going to get somebody turned down, because the SBA's insurance programs help mitigate a lack of collateral. So just because you don't have collateral for a loan does not mean you can't get a business loan. It just means it's very likely it's going to be an SBA loan. Owner's character and experience is critical. It's a subjective judgment by the lender, but if you can show that you have a history of success and you know what you're doing, you're in a much better place to get a loan. And your resume will prove that, your personal credit will prove your character and experience. So make sure to focus on that. I mentioned projected cash flow coverage already. Focus on making sure that your projections are feasible and attainable. And do some arithmetic to show a lender why. So if you're a coffee shop and you're thinking about making $1,000 a day, okay, but make sure you know what $1,000 a day is. How many cups of coffee, what your average ticket is, how that compares with the Starbucks. But just make sure you can answer the question of, is this feasible? Are these numbers attainable? The amount of equity injection is another thing that you need to be thinking about. If you're asking a lender to foot the bill for 100% of the project and you're not putting any of your own money in, that's a negative. If you're putting in half the project, that's a positive. The more equity you can put into a project, the better your chances are of getting approval. Your business's net worth is important. Try to have at least $1 of equity for every $10 of debt on your balance sheet. The business's net worth is sort of like the history of whether you've put money into the business yourself, the history of whether or not the business has made money, or whether you've been able to raise money from investors. And the more cash and equity that there is in the business, and the less debt, the better chance you have of getting a loan in the current. Your personal net worth is also important, a history of savings and ability to bring in cash flow. And any adverse conditions are important too. So if you've got adverse situations like a prior bankruptcy or a prior loss with the government, those can sort of be gatekeepers right there. If you have a prior loss to the government, you've defaulted on federal debt before, you're going to have a real tough time getting an SBA loan now. If you've declared bankruptcy in the recent past, kind of no matter what the other things say, it's probably going to be a no from a traditional lender and really some hard questions from an alternative lender in order to get a loan. Remember, businesses that can show the ability to repay the debt usually can get a deal done before too long, but banks don't want to take much risk at all when they are making a loan. As far as the question of how much money can I get, the real question that you're trying to get there is how much debt can you afford to repay? So flip that question around, not how much money can I get, but how much money can you afford to repay, either from your historical cash flow or from your projected cash flow. Figure out how much cash flow the business will generate on its worst month. And that's probably the biggest payment you can afford. So if your worst month happens to be February, because you do a lot of sort of outdoor activities, maybe you're a landscaper or something, just figure out, like, in my worst month, how much money could I afford? And that's probably the payment right there that you're going to want to get. And you can kind of back into a payment amount by assuming a certain tenure of a loan, 5, 7, 10, 15 years, and a loan amount, and you can kind of figure out what the payment is, and you can kind of back into the amount that you can afford. So remember that magic number is the debt service coverage ratio, the cash flow generated by the business divided by the debt service, has to be greater than 1.2 times. All right, so how much time will it take is the next question. For a microloan, since there's so much technical assistance that goes into it, I think from the time you contact an ECDI to the time when you get a loan, you should be thinking sort of in a 6-month time frame, and it could be faster than that, it could be longer than that, but just think about, if you're going to plan on opening up a food truck next April, think about it being, maybe, I don't know, November when you start or October when you start, so that you've got a good 6-month runway before you're going to actually be in business. For an express loan from a bank, it might take less time, maybe a few weeks, maybe a month. Now, for real estate transactions, it's very variable because approval is one thing, but you also maybe have to have the property appraised, and have an environmental review done, so it could take a couple months to buy a property. Most of the variability in terms of how much time it will take to get a loan, there's not so much on the lender side, but on the applicant side, and it depends on how prepared the entrepreneur is to actually get a loan. If the entrepreneur walks into the bank office and says, "Hey, I want a loan, but I haven't done a business plan yet," you certainly don't expect it to be a very quick process. But if you're in business and you've got cash flow coming in, and you walk in and ask for a business loan for a discrete piece of equipment, that could happen very, very quickly. On the SBA side, if it is going to be an SBA loan, approval is usually almost automatic for most lenders. So if JP Morgan Chase or Huntington wants to get an SBA loan done, they can pretty much snap their fingers and get the SBA's approval. The question is really more on the bank side of them approving the loan in the first place, making that loan available. Whether the SBA guarantees it or not is usually secondary and usually happens pretty much automatically. The smallest lenders don't have delegated authority, so it may take at least a week or two to get a guarantee on a small lender or a community lender if they don't have that level of authority that is granted to larger lenders. All right, the next thing I want to touch on is the Municipal Small Business Initiative Grant Program. This is a supplemental equity grant that's available in certain Cuyahoga County cities. It is a performance grant. You must create a job or two to get the grant. The grant is a maximum of 15% of your project or $50,000, whichever is less. You as the entrepreneur are still responsible for 10% of the equity injection onto the project. The SBA-backed loan will cover the final 75%. So again, 75% SBA loan, 15% grant, 10% owner equity injection. Participating municipalities for that include Cleveland Heights, Fairview Park, Shaker Heights, Lakewood, and Maple Heights. And you'll need to contact the local economic development departments of those cities to apply for that grant. The last thing here is sort of the soft skills it takes to get funding for your business. I always say it takes internal fortitude. You need to be positive, polite, flexible, and to a certain extent relentless to get a loan. Some people do manage to go walk into a bank and come out with a loan, but generally speaking, it can take a little bit of back and forth. It can take asking several different lenders. Different lenders do have different approaches, and where one lender might say no, another might say yes. But try to stay positive. There will be a lot of no and a lot of negativity and a lot of hard questions asked. If you have the ability to stay positive and be polite with lenders, that helps a lot because lenders are people too. They want to get deals done in most cases to put food on the table for themselves and their kids. So try and be easy to work with. Try to be flexible. If someone makes a suggestion about a change that you could make that would give you a better chance of approval, take that seriously. See if you can adopt it. But it does take a lot of stick-to-itiveness because in most cases, people don't just walk in and walk out with a loan. It does take several different trips. It takes some hard questions and some tough answers, a lot of legwork, and a lot of research. And so try to keep that in mind. Okay, so long story short, SBA District Office is here for you. If a lot of these questions are things that still a little unclear, don't hesitate to reach out to us. You can reach out to me at 522-4192. Again, 216-522-4192, or raymond.graves@sba.gov, or Randy can get in touch with me as well. So I'm not far away. Don't mind answering questions.
Okay, right.
All right.
We actually have questions.
I am done with my side of the presentation, and if you have some questions, that would be great.
So we have some questions from Giselle. I hope I said that correctly. I apologize if I did not. Giselle, do you want to? I can read it off, or you can actually unmute yourself and ask the question.
Yeah, thank you so much. And yes, you did pronounce it correctly.
Great.
So I have two questions. Number one, I am wondering what we can typically expect in terms of closing costs for SBA loans. And you talked a little bit about being a startup, and I think you said it was a fifth of the loans that you see approved are for startups. We actually have a startup business, and I'm wondering, what is the expectation in terms of providing proof of salary? I feel like I'm caught in this, what comes first, the chicken or the egg, in terms of, leaving my job to be able to start the business. But then I'm wondering if I'm going to be expected to show that I have income from a salary coming in order to be considered for an approval.
Okay, so the question was, first, what kind of closing costs are associated with an SBA loan? And then second, sort of this idea of is outside income and how much outside income is going to be required. Is that fair?
Correct. Yes. Mm-hmm.
Yeah, so on closing costs, the SBA is pretty restrictive for most of our lenders about what kind of fees can be charged. We do allow a packaging fee to be charged by lenders. Some lenders charge it, some don't. We don't tell lenders exactly what they can charge. The SBA's guarantee fee, what we charge, tends to be about 3% of the guaranteed portion of the loan. It could be less, it could be a little bit more, but if you factored in an extra 2% to your cost to pay SBA's guarantee fee, that would make sense. And the reason I said 2% is because typically we guarantee 75% of a loan. So if you do the math, 3%, times 75% of the loan comes up with the guarantee fee. That's a little unavoidable. It's the SBA's guarantee fee, and the bank will pass it along to you. If they're charging a packaging fee, number one, you might want to find a lender that doesn't charge a packaging fee, but if they are, the maximum most lenders charge on a packaging fee is $2,500. But that is by no means universal. And again, if they're charging a packaging fee, I would look to see if there's other lenders that don't, because it's not an SBA fee.
Okay.
But you specifically asked about closing costs. The closing costs can be, just to make sure we're on the same page, just from the vernacular, closing costs typically are things like your appraisal cost, your environmental cost, title insurance, and things like that.
Mm-hmm.
So if you're looking for like a working capital loan, closing costs could be something like UCC filings. That's where the bank just says we've got a claim on the assets of the company, and that might be like $100 or something like that. So it shouldn't be much. On a real estate deal, it's going to be more because of the title insurance, or the appraisals, or the environmental engineer. On a working capital loan, it shouldn't be too much. Your fees probably going to be majority guarantee fee, and maybe a certain amount of packaging fee or application fee. But SBA doesn't really like banks to charge much in fees, so it should be relatively low.
Okay, thank you.
And then as far as outside income, if you're a startup, it is a chicken and egg situation. What I tell people is banks want to see it make sense. So in like ECDI or a bank, they're going to be really interested to know, do you have the means to make the ends meet in your startup phase? And the answer to that could be, yeah, I have a spouse that has a good job. Maybe they're willing to guarantee the loan, maybe they're not, but at least it's talking about, do you have personal cash flow to pay your bills? It's certainly helpful to have someone with enough cash flow to fund a little bit into the business if it's necessary. When I was in lending, outside income was an absolute thing that was in every application. Does this individual applicant have outside income? Do they have the ability to pay their personal debts if no money's coming in from the business? And moreover, do they have enough money to put some extra money into the business if they can? It would be helpful if you did. So the thing here, like the answer here is, yes, you need to have some outside income. You need to be able to show ability to repay. And if there is some extra cash flow that could be thrown into the operation if you need it, that definitely is a help. For owners who are saying something like, I'm an entrepreneur, I want to do a food truck business because I lost my job, I have no income coming in, and I need to buy a business for myself, that's a tough thing to sell. Banks are just going to say, look, I don't think this is a good idea. There's too much risk here. And then you'll probably get turned down because they're just like, hey, this doesn't make a lot of sense to us. You find a job and build up some cash flow, and then I can think about it. Sometimes if you don't have a partner or someone who can help you out, if you can show a banker that you're going to maintain part-time income and be able to do this business, lift it off the ground part-time, that can be helpful. but there has to be an answer. Randy, do you have a different take on that, or would you say the same? No.
My apologies, Ray. I got pulled over here.
No worries. I was just saying, how do you answer the question that when borrowers have the question of like, should I quit my job or do I need outside income? It's like, to me, it's a chicken and egg thing because I want an entrepreneur to spend full time on the business, and yet I also want them to have outside income.
Right.
So how do you
This
get there? And the answer is yeah. I mean, it's hard. So what do you advise people?
I mean, the one thing that I always tell clients is that the bank is in the business of making their money. You still have to pay no matter what. And so this is, at the end of the day, the entrepreneur has to make the decision and figure out how risk adverse they are. Are they? If they're going to go full on with the business, I hope that business is already generating something. For startup businesses, sometimes it's much more difficult, right? So it depends on where exactly is the business at standing and what is that income. And if you're working on the business, and I have quite a few clients who have started their business, but they have not left their daytime job yet, or they probably reduced their hours at their daytime job, right? So you have to figure out what is the balance for you. But at the end of the day, any lender you work with is in the business of making money. You have to be able to pay back. You have to be able to prove that you can pay back, right? And so those are the tough questions and the tough decisions that you as an entrepreneur have to make, and take into consideration everything else that surrounds you, right? Maybe family life, probably multiple jobs, how much time are you going to put into your business? You have to make that decision on your own. You are going to make the best decision possible, because I can give you maybe 3 different ways to go, but they may not work for you. So you have to make the best decision possible. And, Ray, myself, and all the other SBDCs, and Ray has mentioned ECDI, we're here to help y'all and to navigate the waters, right? And figure out what makes the best sense for you. And so we can sit down and say, hey, can you really afford this, or do we need to reduce how much money you need, or, how are we going to balance this out? So this is a question that you cannot answer with a silver bullet, unfortunately.
That's fair. Thank you.
You're welcome. Anyone else has any questions? I think Giselle was the only one here. All right. If anyone does not have any other questions, any parting words, Ray?
Not at all. I mean, just stay in touch. Good luck. Everybody stay safe. And thanks for tuning in.
Absolutely. All right. Okay, wait, we got something here.
Oh.
Linda, I'm a registered nurse starting up a home care business, so I will be generating jobs in the community. My credit is not the best. Where should I start? That's the question, right?
Yeah, I mean, I think if your credit is not the best, I think starting by working on your personal credit is just a great thing. Like I said in the presentation, if you can get your credit score to 700, it unlocks a world of opportunity for you, rather than seeking out lenders that are looking to take advantage of people. Lenders are looking to come to you to provide a traditional loan, SBA backed or not. But if you really have to apply for financing right now, and your credit is not the best, ECDI is probably the best source to start with, as well as our friends at the HFLA, the Hebrew Free Loan Association, which does 0% loans, but they're very, very small loans. But I would look at some of those non-traditional lenders. Randy, do you have any other sources of financing sensible financing for poor credit or low credit?
Sure, those are probably the top ones. I don't know, Linda, exactly where you are located. There is some incentives through the city of Cleveland. It is competitive, and there is a way to get in terms of actually creating jobs. And I don't want to go into the particulars because we can talk a whole hour about this. But there are some opportunities, and this would not be considered like traditional lending. Nonetheless, credit is extremely important in this country specifically. So there are some local programs and some other organizations that we can link you up with that will help you work on your credit as well. The other thing, excuse me, is that as Ray said, 700 and up is where you want to be. If you're below that, it doesn't mean that you don't have an opportunity for a loan. It just means that your interest rate is going to go higher. That loan is going to be more expensive. And there is a cutoff line for lenders. But you want to have the best terms possible. So if you can set yourself up to position yourself in the best place possible in terms of credit, I would say start with that. If time is of the essence and you need to move forward, then that's something you will have to consider in terms of, do I get a loan at a not such favorable terms. I wouldn't say that it's the ideal loan, but at least it will give you the loan. And if you're willing to take that risk and to pay that back, well, then that's an option. But there are going to be cutoff lines. I know that, and Ray, please correct me if I'm wrong, most banks will cut you off around 640, 620. And that's basically getting the low end of the stick. So it also depends on how much money you need, right? We may have to create some creative strategies to figure out, okay, maybe we can get some money borrowed from family, maybe some organization or some grants. We don't know what that is. So this is very specific to each individual, but work on credit immediately if you can. And Linda says here, what's the ECDI, Economic Development, man, I'm so used to saying ECDI.
It's the Economic and Community Development Institute.
That's it.
Economic and Community Development Institute.
There you go. So,
my boss gets it wrong all the time too. I don't know. ECDI. But there are friends over there.
Yeah, we're so used to just saying ECDI. But it's a great resource to look into. So Linda, if you need help, and I see you added some information here, please feel free to reach out, and we'll help you as much as we can with moving forward on this. Okay, and I think that is all we have. Yep, those are all the questions we have. So we are going to leave it here. If anyone has any other questions or concerns, feel free to reach out to us, or you can reach out to Ray. He already gave you his information. You've received our information via the email and the links. We look forward to working with you, and we are here to help you out. We want to see you go from the stage you are right now to bringing that business into fruition, or getting that business to where you want it to be at. So we're invested in you. Thank you for your time, and we will see you soon. Thank you all. Thank you, Ray.